SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Bocconi webinar, which is this time organized in cooperation with the OECD. Today's topic is housing policies. Housing makes up a major fraction of households' expenditure. It is crucial for people's welfare and quality of life. Housing can be the source of financial crises if combined with high leverage. Housing prices are an important channel for the transmission of monetary policy through income and wealth effects. Rent prices are an important component of inflation developments. A housing price boom can be a side effect of highly expansionary monetary policies. With its new Housing Toolkit report, Brick by Brick, Building Better Housing Policies, which has just been released a couple of days ago, a link can also be found on the SUERF event homepage, the OECD presents a substantial and state-of-the-art compendium on good housing policies. We are privileged to have the leading head behind this report, Luiz de Mello, Director of the Policy Studies Branch, the Economics Department of the OECD, to present us selected main findings. Then, John Muellbauer, Professor of Economics, Senior Research Fellow, Nuffield College, and one of the top global experts on housing markets, will provide a detailed discussion of the report. Subsequently, Florian Kajuth, Head of Section Macroeconomic Analysis and Projections Division in the Directorate General Economics of the Deutsche Bundesbank, will offer a German perspective. Last but not least, Rainer Martin, lead economist at the JBI, will cover implications for the CEE region. Without further ado, a warm welcome to Luiz, and I hand over to you.
Thank you very much, Ernest. It's a great pleasure to be with you today, to join SUERF and Bocconi for this on this occasion to discuss a few of the findings of this work by the OECD. The OECD has been working on housing issues for a number of years now, but the work was always done in a rather fragmented way, if you will. It was different policy communities looking at housing issues from their own perspectives, from the interest and the point of view and the interest of their own constituencies. And housing is a very complex issue, as we all know. It touches on a variety of policy areas. So we thought it was important to take stock of what has been done over the last few years from this more holistic perspective, meaning looking at the different interactions across policy areas, looking at the complexities and the multidimensionality of the challenges that can be identified in the housing area. So the motivation for this exercise was basically take stock, recognizing the complexity of the issue, and see where we could add value to discussions and bridging the gaps that we all know exist in terms of measurement, in terms of data, in terms of information, not only on housing, house prices, but a variety of issues related to housing that I'll come back to over the next few minutes. So what, the next slide, please. So what we thought we could do today is basically to raise a few points about current challenges and trends in the housing area, at least the way we've been looking at them for this project. Then on the effects of the pandemic on housing, what we've been seeing basically over the last year and a half, and then a few words on key policy insights that have emerged from this exercise. I think it's also important to say at the beginning that this is not the end of this undertaking. We are already starting to work on following up on some of the issues that we dealt with in the course of this current phase of the project, areas where we couldn't do as much work as we thought would be important, and we hope to focus on over the next couple of years. If time allows, I can come back to this issue of what, so that you can all have an idea of where we are going from now. Next slide, please. Next one. Perfect. So one of the obvious findings and one of the most salient features about housing markets over the last 20 years, really, is this very sharp increase in prices and rents that we have seen over time in many OECD countries. If you see in this chart, the blue bars for rents and the triangles the blue bars for house prices and the triangles for rents, you see that in countries like Canada, like Sweden or Australia, over the last 20 years, house prices and rental prices in some cases have risen by an enormous amount. Next slide, please. And that has also taken place within countries. I mean, one of the probably most misleading things about national averages when it comes to house prices is that they mask very drastic and significant variations within countries, and also that they mask how supply reacts to changes in demand at the regional and local level as well. So what we are seeing is that this very sharp increase in prices and rents that we saw in the first chart are very closely related in many countries to a lack of responsiveness of supply. And then you can see in this chart for a selected number of countries how metropolitan housing construction basically reacts to changes in demand. Very large variations in a country like the US, for instance, across metropolitan areas, or countries like Sweden or even Portugal, and in other parts of the OECD, much lower responsiveness of supply to shocks in demand. So what we see is that this mismatch between supply and demand is obviously at the heart of some of the pressures, upward pressures that we are seeing on prices across the OECD area. Next slide, please. So as a result of that, housing has become less affordable, especially among low-income households, vulnerable social groups. And if you look at this chart, for example, you see that already on average at the OECD, about over a third of those households at the bottom income quintile, the bottom quintile of the income distribution, already spend more than 40% of their disposable income on mortgages or rents. If you look at the yellow bar there, which is the OECD average, you see that, again, over 1/3 of those households already spend more than 40%. When it comes to rent, a much lower number, about half of that, when it comes to subsidized rent, and a share between those two cases that refers to homeowners with mortgage. So really an important problem of affordability, which is the word that we've been hearing the most when in our dialogue with policymakers in countries, that their number one concern tends to be that of affordability, and that can be traced back to this mismatch of supply and demand that I alluded to before, which is at the heart of the sharp increase in prices as we can expect. Next slide, please. Another issue that worries policymakers is over and above the quantitative aspect of affordability, which is like shares of income that are accounted for in relation to housing costs, but also a more qualitative indicator which has to do with quality gaps in the housing stock in many of our countries. One aspect of these quality gaps that we looked at is overcrowding. So the share of households by income quintile that live in overcrowded spaces, and you can see for the OECD average that close to 20% of households in the bottom income quintile live in overcrowded spaces. Unsurprisingly, a much lower number for households in the top income quintile. But in addition to that, you can see already a very large dispersion in the share of overcrowded housing across the OECD membership, with rather high numbers for countries like Mexico, Latvia, and Poland, and on the other hand, very low numbers for countries on the other end of the chart: Spain, Japan, Ireland, and Canada. So it's not only the quantitative aspects, but also the qualitative one that is very closely linked to well-being considerations, and that also matters from the vantage point of the policymakers we've been looking at. And another aspect, which at least given the history of our work on housing, is becoming more prominent, which is the environmental sustainability of housing. So we've been looking at a variety of indicators that basically could reflect the footprint of the housing stock. And if you look at an aggregate number, about 17% of total CO2 emissions on average in the OECD area. About 70, close to 1/5 of that is accounted for by the residential sector. The huge disparities that you see across countries. If you look at other indicators such as emissions of fine particulates, you get much higher numbers, close to 40%. That are accounted for by the residential sector. And you see in some of the countries, especially the ones depicted in red, you see that the housing, the residential sector accounts really for a very large share of total CO2 emissions in those countries. So very important to look at environmental sustainability considerations as well, especially in those parts of the world where the housing stock is old and not necessarily in line with the most strict standards of energy efficiency. For example, just to give you a number, in Europe, 80% of the housing stock is at least 30 years of age, 80%. So you cannot expect that housing stock that is already relatively old to have the same emissions efficiency, energy use efficiency as housing that is being built right now. So that points to a lot of work that needs to be done to bring standards up so that the environmental footprint of housing can be reduced. And there are a number of other indicators that reflect that as well. Next slide. So COVID-19 and housing. We also, so once we've looked at these basic features of the housing market, affordability, environmental footprint, quality indicators as well, we were also hit by the COVID pandemic as we were developing this line of work. So what we did there was basically to at least in the immediate aftermath of the pandemic, to look at the measures that governments were putting in place to cushion essentially tenants, but also mortgage holders from the immediate impact of the pandemic on economic activity, on income losses, and so on. So we took stock of what different countries were doing in the OECD area and tried to group those measures according to a typology, which is what you have in front of you: measures related to tenants, measures related to homeowners, and other complementary measures that were taken in different parts of the membership. But by and large, the bulk of the measures had to do with basically suspending foreclosures and evictions, extending contracts, and in many cases also forbearance in the payment of mortgages, in the payment of rents, as a way of providing breathing space, if you want, to tenants and homeowners. In some cases now, these measures are being phased out, and we are trying to take stock as well of progress that is made in that area as well, in recognition in many cases that emergency measures, while needed and important at that point of the crisis, if they are left in place too long, they may have adverse consequences for the efficiency of real estate markets more generally, beyond housing, residential use itself. Another impact of the pandemic that we've been monitoring is basically related to the PMI indices for construction. There aren't that many countries that have PMIs dedicated to construction activity, but what you can see in a selected number of countries is that the behavior was fairly uniform, in the sense that a large hit in the second quarter of last year, as the economies or economic activity was put on hold as a result of containment and confinement measures. A very rapid pickup in the third quarter, given the confinement that was in place in many countries. And what we can see by and large is that in a number of cases that the PMIs have come back to the levels that we had before the pandemic. Next slide, please. We also tried to look at countries countries that don't have construction focused PMIs. So here we basically looked at Google Trends indicators. So those are indicators of web search activity for certain aspects that are very closely related to rental markets, to construction, to activity broadly defined in the construction and rental and transactions sides of the market. Those indicators tend to track relatively well the construction PMIs for countries where we have construction PMIs. And what you can see is that by and large, the black dots, which are the latest numbers that we have for last month, are already above the green lines, which were the pre-COVID peaks. And needless to say, already much higher than the readings we had at the trough of the second quarter of last year. So all these PMIs and the activity-based indicators point already to a fairly rapid recovery in confidence and in activity following the pandemic. Next slide, please. Indicators regarding residential construction have also rebounded. So just one additional piece of information that confirms the previous one. You see the green lines there related to the latest numbers that we have that are well above for most countries the trough of the second quarter of last year. Next slide, please. And despite this pickup and this rebound in activity, we see that in many countries prices have continued to rise. This chart basically plots the year-on-year changes that you had before the pandemic. So last quarter of 2019 with year-on-year changes in the last quarter of last year. And you can see that where prices were already rising fast, they continued to rise in the course of the pandemic. So that adds to the longer-term trends that I started off with by comparing changes in house prices and rents over the last couple of decades. And a lot of dispersion that we observe, again, rather unsurprisingly, within countries, which in many cases are already pointing to some demand shifts. If you compare the behavior of prices and activities within metropolitan areas in some parts of the world, we already see this phenomenon that we observed during the crisis of demand shifts towards away from central business districts, from more central residential areas towards peri-urban areas and so on. So we see already as a result of the pandemic, some trends that may or may not remain in place, and to the extent that they do, they will have obviously implications for real estate markets beyond the residential sector itself, and hopefully we can come back to this point in the discussions later on. It's one area where it's very important to monitor developments to see how durable the trends of the last few months will likely be, and what implications they will have, not only for tracking demand, understanding demand shifts, but also understanding how those demand shifts may or may not be matched by supply developments, and what type of pressure that can continue to have on prices. And all that over and above broader issues related to urban development, provision of social services in metropolitan areas, and so on, that we may come back to later on. And that's one part of the work moving forward that we wanted to pay some attention to. Next slide. So a few policy insights. As I mentioned before, housing deals with a variety of policy areas, and we looked at areas that are as diverse as, for instance, the direct provision of social housing by governments, to regulation not only of environmental standards, but also everything that has to do with the zoning within urban areas, land use regulation more broadly, regulations regarding landlord-tenant relations, taxation, and so the full range of policies that have an impact on housing outcomes. And a big part of the work was really indeed trying to put together indicators not only of outcomes, but also of policy setting in different countries, and to the extent possible how they have evolved over time. So one message that I think is important given the discussion that we're having today, and that are closely related to central banks, financial market regulators, and so on, is the role of macroprudential regulations in trying to reduce credit and house price growth, but also fluctuations in housing house price cycles, which we all know tend to be very strongly correlated with fluctuations in business cycles. So to the extent that we can preserve business cycles from house price cycles, the better in terms of basically trying to make our economies more resilient, reducing the amplitude of business cycles and so on. So what we try to do is basically a comparison of one of those macroprudential regulations, the one that happens to be most common in countries, loan-to-value caps, and we try to compare countries that having tightened their LTV caps in countries that have not, basically trying to identify control and treatment groups using a propensity matching technique. And what you can see is that in countries where LTV caps have been tightened, you tend to have lower credit to households, you tend to have then lower house prices. As a result, you also tend to have marginally lower housing investment and marginally higher private consumption, which may reflect positive income effects as a result of this measure. So an illustration of the use of a macroprudential instrument and how it affects house prices and other indicators related to housing at the same time. So this was one set of policies we looked at. Other regulatory and tax measures that we looked at, especially insofar as affordability is concerned, what are the policies that are most closely associated with a reduction in the share of household disposable income that goes to housing, to finance or to cover housing costs in general. We looked at different aspects of deregulation of rental markets. One, for instance, rent control being prevalent in some countries. So if you deregulate that, if you gradually remove rate controls, what happens to house prices and affordability? And you can see across countries a sizable effect of that. We looked at the removal of a mortgage interest relief, which a few OECD countries still have, and what impact it may have on house prices. We looked at land use policies, as how could we basically make sure that land use policies are more flexible and then allow for, or at least remove an impediment to supply responsiveness supply responsiveness to demand shocks. And we also see that in places, especially countries where land use policies are more restrictive, that there is a considerable positive impact there on supply responses and then house prices. Next slide, please. We also looked at social housing, and that's an interesting aspect that we look at. There are different types of social interventions or government interventions in the social housing area. In some cases, direct provision through investment in housing developments. In other cases, a variety of transfers for housing development, a variety of transfers to households directly. And we see that across the OECD area, there has been a gradual decline in government investment in that sector. We argue that it's very important to have to resume or to restore the ability of governments to invest in that area because of multiple considerations, including the issue of environmental sustainability, to the extent that that provision can be done according to higher standards of construction. There can even be a demonstration effect for the private sector through government investment in the construction of social housing. In many parts of the OECD where rental markets are relatively illiquid or less developed, social housing could focus on developing that segment of the market, which is important in terms of a post-pandemic reallocation, and that's an issue I'll come back to. The next slide, please. If we think of a number of regulations and policies as posing obstacles to residential mobility, then at a time when our economies are recovering from the pandemic and where considerable reallocation may be needed as a way of basically allowing for a smooth restructuring of capital and labor away from sectors that may be affected more adversely and in a more durable manner by the pandemic towards sectors, activities, firms that may be growing faster. So to the extent that you remove those obstacles to residential mobility, you may be favoring labor mobility overall. We know that countries where residential mobility tends to be low, that labor mobility tends to be low, and that this period of post-pandemic reallocation where labor mobility may be important, then it's important to reduce those those obstacles to residential mobility. We looked at a variety of policy interventions, taxes on financial and capital transactions, for instance, that many OECD countries still have, and that tend to be an obstacle to buying and selling property by adding costs to that. So if you reduce that, you tend to have an impact on the estimated probability of people moving over the medium term. The same for notary fees. Countries where notary fees are high, they will have a higher cost of transaction that tends to discourage residential mobility. We looked at the elasticity of housing supply, for instance, how responsive supply construction is and how it affects residential mobility. We looked at regulations of landlord-tenant relations. The more restrictive they are, again, the stronger the disincentive for people to move, rent control being a very important one, especially if you think of, for instance, people who have access to social housing, but whose rights are not portable across, maybe not as advantageous to move as it is when in situations where you don't have the same type of friction in labor markets. We also looked at the stock of social housing as a way of facilitating that mobility. Next slide, please. The bottom line of all that is that there are lots of potential synergies across policy areas, but also a lot of trade-offs that need to be acknowledged. What we try to do also is to take stock of a variety of policy interventions and what type of trade-offs and complementarities they would have. So, for instance, the first line there, if you invest to build green social housing with portable rights so that people are not really stuck, if you want, in the place where they are eligible for housing, that tends to be have a positive effect on affordability in the near term, also in the long term, by having a stronger impact on prices in the long term. Labor and residential mobility, also good for sustainability to the extent that that provision is in line with state-of-the-art standards of environmental or energy efficiency, for instance, or other environmental criterion. But you also have cases where you have trade-offs. Take, for instance, the last line there. If you require certain energy performance standards to be met through tighter building codes, you tend to have, obviously, a positive impact on sustainability, however defined, but you may also put upward pressure on construction that may be passed on to prices, and that could then, unless accompanied by other measures that then mitigate that effect, negative impact on affordability over time. So that was the type of the gist of the different considerations that for every policy measure that we looked at, we try to look at those positive and or negative repercussions that may have for other policy objectives. Next slide, please. And this is essentially what the toolkit tries to do. The toolkit is essentially not only these more conceptual discussions on policies, but also a dashboard of indicators that contains all that information on outcomes and policy settings, and trying basically to see what are the areas where, if you look at these three broad objectives of sustainability, inclusiveness, which includes affordability, and efficiency, what are the areas where you would have interactions where those interactions may be positive or negative as a way of bringing to the fore the potential for synergies and the need to deal with trade-offs. Next slide, and I will conclude here, is essentially, if you go to the website of the housing website of the OECD, you will see all these different interactions in a very dynamic tool that allows you to look at the different areas of policy, taxation, spending, regulation, urban planning, and so on, the different type of effects you may have across those different, among those different policies, and how they allow you to basically make progress towards inclusiveness, sustainability, or efficiency. And you can see there that through those different policies, what type of evidence you have, what type of synergies you may achieve, or what type of trade-offs you may also identify. So I'm just showing this slide as a way of basically encouraging you to take a look at what is available in the on the website, and how you can basically think of ways of navigating those different combinations of policies and objectives in a way that ultimately our ambition from the very beginning was, to make sure that this can be a policy tool that policymakers can use to inform their own decisions. I will stop here, and thanks again for the opportunity to join you today.
Thank you very much, Luiz. I will now hand over to John to provide his comments. John, the floor is yours.
Well, I'm most grateful to you for inviting me to participate in this great event, and congratulations to the OECD and to Luiz. This holistic approach to housing, the economy, and society is very praiseworthy and is an amazing example of evidence-based policy formation. And the OECD, of course, has unparalleled access to data and to excellent analysts. There are immense benefits from this holistic approach, as Luiz has pointed out, in dealing with climate issues, efficiency, inclusivity, sustainable growth, intergenerational equality, and financial stability. But I think in the background, we have to acknowledge that there's great resistance to implementing many of these policies. The know-nothing climate change deniers, the land-owning interests, and individualistic ideology that denies the externalities that Luiz has been talking about, these interrelations. And of course, monopolistic media that promulgate misinformation. I think many citizens, perhaps most, don't understand gender equilibrium, the many interrelations, spillovers, and feedbacks, and possibly unintended consequences that Luiz has been talking about. I think the OECD report is really brilliant in uncovering these interrelations. Three aspects of sustainability that the report highlights are climate change, financial stability, and inclusiveness, reducing inequality. I think a subtext should be that protecting liberal democracy against the rise of populism is an important issue in the background, because the sustainability agenda, if pursued, would help to protect us against the rise of populism. I think the rise of populism is pretty well understood now. In particular, the global financial crisis that generated socialism for the bankers and austerity for the rest, the rise in inequality and the fear of mass migration. And housing policy reform is linked to many of the solutions to these problems. Now, because of the special interests and the resistance, many of the reforms are quite controversial. So I think that the report inevitably had to pull some punches. It was less outspoken than it might have been. I think on climate, the report could have said a bit more. The chapter on housing and the environment is really excellent, but it doesn't mention the words climate crisis or net zero. Now, scientists are really worried about this catastrophic tipping point in the global climate that looks to be ahead. This article on Nature, the first reference here, and the draft IPCC report coming out early next year, and the UN emissions gap report, they all highlight how risky the situation is. And in the background, the global climate system has these amplifying feedback loops that increase the probability of mass species extinction, sea level rises, and other disasters. And I've highlighted just 5 of the feedback loops, the amplifying feedback loops here that cause these issues for the global climate. So as I say, chapter 7 of the report, Reconciling Housing and Environment, is really excellent, and many policy recommendations are outstanding, but I think it's too sanguine. Luiz has already referred to the impact on the climate of the residential sector, and as he said, the report highlights the complex links that tie housing policy with the environmental agenda. Land use policies, regulations, subsidies, taxes to reduce the carbon footprint of construction and improve energy efficiency, and of course transport policies that affect housing. But as he said, some of those policies potentially increase affordability problems and social exclusion. So these are issues I'd like to come back to. The scientists say that we need to hit net zero. The globe needs to hit net zero by 2050, and earlier for rich countries, and earlier for the housing sector than others that are even more challenging to address. So new houses should be net zero or ready to be made net zero, or they risk becoming stranded assets. And mortgage pricing needs to reflect these risks. And that, I think, requires really wholesale reform by the regulators across the insurance and banking sector to achieve that. One major omission in the report is that it doesn't mention carbon capture and storage. And many scientists think that's going to be critical to solving the climate crisis. And housing is particularly relevant here because the use of wood as a building material is absolutely fantastic for carbon capture and storage. The UN emissions gap report and the UK's climate change committee both noted these facts. Timber is amenable to off-site modular construction methods that reduce construction costs, but it needs reform building codes. There are some really wonderful examples of new technologies. And we know that wood burning adds to CO2 emissions and generates dangerous small particle pollution, as Luiz pointed out. So build rather than burn. I think there's while green property taxation has been mentioned as a potential, I think maybe it could have had a bit more attention, and I'll come back to that. And more generally, there's the issue of new technology. If you speed the adoption of new technology, you bring down costs in the medium run. So even if in the very, very short run, costs rise, in the medium run, they have the potential to fall. And new regulation, taxes and subsidies to speed adoption can be very helpful. So all of those have the potential to produce synergy, to resolve the conflict between affordability and equity and meeting climate goals. So let me turn to property taxes, which is one of the central recommendations of the report, relying less on transactions taxes and more on annual taxes, with a particular emphasis on the land component. The need for this tax shift has never been greater because the pandemic has generated huge structural changes in employment patterns and in housing preferences, many of which are going to be long-lasting. So that implies major adjustment in spatial patterns of employment and residence. And as Luiz pointed out, transactions taxes are a serious impediment to the kind of this adjustment that we need. And then, of course, there's the whole affordability issue that his presentation highlighted. So, because of the pandemic, the easy money policies pursued by OECD central banks have fueled further large wealth gains for property owners relative to the rest. And so that's actually made all these problems even more serious. Intergenerational inequalities widened further, and the young and the less affluent were so disproportionately affected by the pandemic. So the fact that local house prices reflect more heavily than ever access to good transport, education, healthy environment is a really serious issue for social exclusion. Now, the report highlights the need to keep valuations for property taxes in line with market prices and calls for a shift to land rather than the structures. It also confirms, based on excellent previous research at the OECD, that annual property taxes linked to recent market values improve macro stability and long-run rates of growth. I'll come back to the stability issue in a moment. But a further issue is that fiscal issues are going to come to the fore. OECD countries have accumulated massive debt burdens because of the pandemic. So it's very likely the tax base has to be broadened and increased to raise the necessary taxation. And that's where recurrent property taxes, which are so much better for economic growth, come to the fore. So let me come back to this stability question. Why is it that property taxes linked to recent market values, combined with macroprudential limits that Luiz talked about, why do they improve stability? Because they've reduced the incentive of property speculation based on the expectation of high rates of return, which tend to be based on recent property appreciation, something we explain in our forthcoming survey paper. Now, the benefit is not only to macroeconomic stability, but also to regional stability. These taxes, especially where home equity withdrawal is easy, help dampen down drivers of higher regional inequality. Now, how does that work? Rises in land prices in growth hotspots should be a dampener, because they should deter further in-migration and further growth of those hotspots. But what happens is that many potential migrants to the hotspots will keep coming in anticipation of further capital gains. And residents sitting on large capital gains will postpone moving to cheaper locations. So annual property taxes dampen this kind of speculation, which otherwise prolongs swings in widening regional inequality, a particular issue in the UK. So the report highlights both this issue and the reduction of man-made obstacles to construction in high-demand areas to dampen regional inequality. And here is a couple of quotes from the report, which I think are highly appropriate. Discussion of segregation, why it matters so much, and why commuting times can be quite a good indicator of this kind of exclusion and inefficiency that occurs. So with that background, let me raise some issues about the UK, because the UK illustrates strongly all the issues raised by the report. So one really fantastic feature of the report is the marshalling of international evidence on how policies, structural features, and outcomes differ between countries. So in this benchmarking exercise, the UK has high levels of restrictions on land supply, as you've seen, and low levels of rent regulation. I have a slight query on the rent regulation index that the OECD uses, because in my view, UK rental market is actually quite dysfunctional. Short contracts, little tenant security, inadequate quality controls, and high tenant dissatisfaction levels. By contrast, the German system with long tenures and flexible rent controls actually has some advantages. Another OECD benchmark is the marginal effective tax rate for owner-occupied debt-financed housing investments. And the UK comes out very well, apparently, on that, because it has relatively high marginal effective tax rates compared to other countries. And I would argue that the measure is a little bit misleading as far as the UK is concerned. Valuations for council tax are 30 years out of date, and the tax is highly regressive across property valuations and by region. So it retains some of the terrible features of Mrs. Thatcher's poll tax. So here's some information on this regressiveness. So on the left-hand side, what's being explained here is the banding system. So taxes are based on bands, value bands. So the lowest value houses in A have the highest tax rates. And on the right-hand side, regionally, the poorest regions have by far the highest average tax rates. So this is really pretty monstrous. Apart from a very dysfunctional council tax system, the UK has pretty high transaction taxes on housing. So that, combined with the restrictions on supply, generates the UK as the outlier in commuting times in European countries. It has the highest commuting times in European countries. And of course, we have a major housing affordability problem. So one must hope that the OECD report will be listened to in UK government circles. And it turns out that the holistic policy recommendations are pretty closely aligned with a four-part approach to address the UK's problems that I set out a few years ago. So the four ingredients are to better capture for society the rise in land values induced by granting and planning permission, to expand social house building, to incentivize local authorities to give planning permission. So the first three are very much focused on the supply side, improving the supply response, and fourthly, to reform the UK property tax system, which, as I've noticed, is pretty unfair. Let me conclude then on how a green land value tax as a split rate property tax could marry some of these concerns with the environmental issues that are so important. So the way this would work would be to have a standard per square meter charge on land, plus a surcharge on the building depending on its energy usage, so measured by the energy performance certificate. Obviously, regular revaluation, and very importantly, deferral, to offer everyone the right to defer to protect cash poor but land rich households. In turn, the tax authority would register an interest in the land at the land registry equal to the unpaid tax for each year deferred to be settled when the property was sold or transferred. No discounts for single persons or second homes, but a surcharge on owners who are not UK taxpayers or pensioners to discourage foreign speculators, a big issue with the open capital markets in the UK. And to take some of the edge off the resistance, an allowance linked to regional land prices so that the high-priced regions don't suffer such a disproportionate rise in taxation, and then phasing in over several years. And of course, a cut in transactions taxes. So some of these elements, the deferral, the allowance in the regions, and the phasing in, would anticipate the pushback from the haves and the special interests that one can expect. It seems to me this kind of reform might have uses in other countries as well, and very much reduce the conflict between the green agenda and the affordability agenda. Let me conclude by congratulating the OECD again, and Luiz in particular, for organizing this amazing research effort. Thank you.
Thank you, John. I will now hand over to Florian to give the German perspective.
Let me start by saying that I'm very impressed by the report that covers a lot of ground and that's extremely rich. At the same time, it's very accessible. It's a very good read. So in my discussion, I will give a brief overview of the German housing market, and I will focus particularly on the role of land. And then I will add some remarks on how our view fits in with the report. So I can fly through this slide because Ernest has already covered much of it. So from a central bank perspective, what's particularly interesting about housing prices is their role in macroeconomic analysis and financial stability analysis, and also for inflation measurement. So I will just briefly mention these three aspects and then jump right into the current situation on the housing market in Germany. So the German housing market has been in a boom for more than 10 years now, starting around the year 2010, with prices starting to increase most strongly inside the big cities. So you see that in the left-hand graph, the green bars show the rates of price increase in the 7 major cities, and these price increases slowly spilled over to the areas outside urban regions. So in 2019 and 20, rates of growth were probably more or less identical across regions in Germany at a very high rate compared to Germany's historical record of house price developments at around 6%. At the same time, housing supply started to increase, as you can see by the increase in the number of building permits, incoming orders, or housing investment. So a strong price increase together with a supply expansion points to a situation of a demand-driven housing price boom that is, of course, strongly influenced by the low interest rate environment and also by the income gains of private households during the long upswing of the German economy that more or less provided the background to the housing market boom of the past 10 years. What's also interesting is that in the year 2020, during the pandemic, house prices didn't fall, they barely budged, and also supply didn't really go down. The expansion of housing continued at more or less unchanged pace, and we didn't see a major disruption to residential construction in 2020. So what you can do is you can go a step further and decompose house prices into their land price component and a construction price component. The idea behind that view is that residential property can be viewed as the bundle of the value of the land and the value of the building itself, the structures on which sit on the land. And if you decompose house prices into the land price and house construction price component, it emerges that the increase in growth rates was more or less entirely due to an increase in growth rates of land prices, the orange bars, while construction prices also increased, but the rates of increase didn't grow as much as those of land prices. So an interesting analysis that can be run by separating these two price components is to estimate standard macroeconomic models of house prices, but distinguishing between their effect on construction prices and land prices. And from the results, one can look at two important relationships that have to do with affordability or efficiency. And the first one would be the price effect of a supply expansion. By how much is house price growth dampened through an increase in supply? And what emerges from these analysis is that an increase in building land, in available building land, dampens land prices and therefore house prices, while more residential investment puts pressure on land or construction prices, all else equal. So that means without an accompanying increase in the available building land, more residential investment will increase construction costs, put pressure on construction prices, and therefore stimulate house price growth. So what a conclusion from this insight is that it's more about the expansion of building land than about the expansion of residential investment with respect to affordability. So you can do more by expanding available building land than by building more on the same square feet of land, if you're interested in the cost and the price, cost and price effect. The second important relationship that one can look at through the lens of this analysis is the aggregate supply elasticity. So that's the question: by how much is housing supply stimulated through an increase in prices? And the interesting finding here is that it also depends on the house price component one is looking at. For example, land price growth stimulates actually housing investment from an aggregate perspective. And the idea behind that, the intuition is that for a given level of building costs, construction costs, the net present value is higher after an increase in land price. So more projects are worth getting realized. While construction price growth dampens residential investment. And this is the usual channel. When it's more costly to build, then fewer projects get realized, all else equal. So our finding is that it's kind of instructive to separate the price components of house prices into land and construction price components to further pinpoint the best possible ways to do more for affordability or efficiency. The important role that land prices played in the recent upswing on the German housing market also raises the risk of price exaggerations, because the land price component is closer to the asset price component of a house. So this is more at risk of overvaluation than the actual brick and mortar in the building. And indeed, during the last 10 years, house price to income ratio has increased enormously in Germany. That's the blue line. And also the price to rent ratio has increased a lot. Interest rates at the same time contributed to improve affordability for those who could kind of jump the down payment hurdle. That's the red line. That's the annuity to income ratio, which decreased for several years after 2010 when interest rates came down, and after that interest rates were more or less unchanged since 2016. So price increases stronger than income increases contributed to a slight rise in the annuity to income ratio. Its level is still below the level before 2010. So it's still kind of affordable in the sense that those households who can afford the down payment, which is in some cases really huge, then it makes more sense to buy. But the initial hurdle is of course a high one. This was the view on the housing market as a whole on the left, and we can zoom in on the cities, where we can also look at price-rent ratio for apartments, and we see that price exaggerations during the recent housing boom are even higher than for Germany as a whole. That means outside the urban regions, valuation is not yet as severe as in the cities, but as I explained in the beginning, since house price growth rates aligned between urban and non-urban regions, one can expect to spill some of the price exaggerations over to the more rural areas. Right, so what's the key takeaway from my short intervention here? So I'd like to highlight that land price is maybe a more important transmission channel of shocks to overall house prices than thought. And this also holds for housing supply. Maybe that's even more worth pointing out, because the literature on the effect of land prices on housing supply is really scarce. And second point is that the land component is particularly susceptible to overvaluation compared to structures. So these two elements serve as a very nice illustration of the importance of housing in the OECD report of the land use regulation, because the land use regulation is in the long run the factor that basically determines the building land supply. And so I want to draw your attention to chapter 8 of the report, which I found particularly worth highlighting, because that speaks to exactly these issues, affordability and efficiency from the perspective of the land price component in houses. There's one caveat that I'd like to add, and I think that point could be stressed a little more in the report, and that is the question, what's the optimal degree of flexibility of land use regulation between very strict regulation and completely flexible? Since residential investment is lumpy and partly irreversible, I think that the optimal degree of flexibility lies somewhere in between. So we do not want to have a very, very flexible land use regulation that allows for construction at every price signal without taking into account the repercussions that might arise more in the future, that were illustrated very starkly during the house price boom in Spain in the early 2000s. And second point I'd like to highlight, and which was very nice to see in the report, is that the report stressed the data gap in the domain of land use regulation. So for all the importance that land use regulation has in terms of housing affordability or efficiency, we know actually very, very little about what are the necessary parts of land use regulation that are kind of justifiable from a welfare point of view, and which ones are the ones that we should get rid of. And so the report suggests a data collection exercise to get a better understanding of the actual state of play of land use regulation across countries in a very differentiated way. And I think this is highly welcome. And I would very much hope that this that this realizes, and this will be done in future work at the OECD. Thank you very much.
Thank you very much, Florian, for offering insights on developments in Germany, and in particular for pointing out the importance of the distinction between land and building prices in our analysis of housing prices. With this, I hand over to Rainer for a CEE perspective. Rainer, the floor is yours.
Thank you very much to SUERF and to Ernest for inviting me. Let me also congratulate the OECD and Luiz for really an excellent report. The policy discussions on housing, and especially in those countries where I follow it, they are often a little bit short of, say, economic foundations or economic thinking. And I think this report really contributes to filling very important gap. So I think it cannot be underestimated how important this piece of work is. So I will focus on the countries in Central, Eastern and Southeastern Europe, and more specifically on the EU countries in this region. Why on the EU countries? Well, simply this is driven by the data availability, which is somewhat better, but looking at sort of more piecemeal evidence or data at post-communist societies further in the east or in the southeast, the situation in this part of the world does not seem to be very different. So obviously the residential real estate markets in this region share many similarities with residential real estate markets in other parts of the world. Well, this is clear. So if you look at some of the key features, they experienced a major residential in real estate driven boom and bust during the first decade of this century. They saw in recent years very dynamic residential real estate price developments, and also, and this is very important, they saw a lot of macroprudential policy activity in an effort by the local authorities to smoothen the RRE cycles. And last not least, the developments in this part of the world also continue to be generally buoyant more recently. So despite the COVID-induced severe recessions, which brings them in sync with the situation in most of Europe and also in many other parts of the world. So all of this is really pretty much what we see in the rest of the world. But this notwithstanding, and this brings me to the specific points, the RRE markets in the region, they are to some extent still distinct from that in some other parts. And I would call that the long shadow of transition. So what are these specific points? I would say mostly 2 or 2.5, let's say. So the first one is that the home ownership rates and the level of indebtedness in the region. The home ownership rates are extremely high, and I'll show you to this in a minute, whereas the indebtedness levels are actually not so high. And this is mainly an impact of the post-transition privatization process. So something that dates back like almost 30 years ago, but you can still see this in the data. The second point is the quantity of housing. You can generally say that housing is definitely not abundant in this part of the world, and in particular not in the regional growth poles. And that is an impact of the pre-transition planning processes that you saw and a long degree of underinvestment in RRE construction. And the third point, and this applies only to parts of the region, is that there are deficiencies in the quality of housing, which has something to do with pre-transition building standards and again with underinvestment. So these specific features, they make some of the OECD housing policy recommendations, in my view, even more pertinent to the CESEE region than to other parts of the world. And importantly, they also sharpen some of the policy trade-offs that are very well highlighted in the report. So for example, between affordability and environmental building standards. So let me now quickly take you through a few sets of data just to illustrate the point that I have been making, that I would like to make. This chart here shows you home ownership and indebtedness, and this is home ownership. And basically, when you take the blue and the yellow parts of these bars together, it gives you the total home ownership in the countries. And the countries in Central, Eastern, Southeastern Europe, I marked them here with these little red boxes. So what you see in these countries is that the total share of home ownership is extremely large. So sometimes 90% and more. And this is really across the countries. At the same time, the share of homeowners without mortgages tends to be relatively large too. So not so many people in this part of the world actually have mortgages or housing loans. And that, again, that dates back to the privatization process. Now, what does it mean for policy? Well, first of all, it means that there is a very limited rental market in these countries, and that, as nicely put out in the report, has of course a negative impact on mobility, and probably is also a barrier for growth, as people are less able to move from relatively lagging regions to the growth poles in their countries. It also means, because so many people do not have a mortgage, that a change in house prices will have a large impact on wealth, but a change in interest rate will probably be less dramatic due to the low share of mortgages. This chart here is a little bit more complicated, but it shows you the share of population with a housing cost burden over 50% of disposable income. So actually, Luiz showed a similar table. Now here the focus is on the EU countries, and again, I highlighted here the countries in Central and Eastern Europe. So the share of population where housing costs are more than 50% of disposable income are actually very large in some of these countries. So that's the dark blue diamonds. They refer to tenants. So those part of the population that live in rented accommodation rather than being homeowners. And it shows that there are severe supply constraints in this part of the rental market, and hence there are price pressures on the population. As I said, this is not the same across this part of the world, but in many countries it is certainly above the average in the European Union. Let me then go to the quantity of housing. This is the second point I would like to illustrate. And this little map here shows you the share of population living in overcrowded houses. What does overcrowding mean? In this case, the definition of overcrowding means that, say, a family of 2 adults and 2 small kids has at least 3 rooms. If they have less than that, they live in an overcrowded accommodation. And of course, depending then on the composition of the household, this will change. But it's not a particularly onerous definition, I would say. And the picture speaks for itself. Essentially, almost all countries in Central Eastern Europe, including ex-Yugoslavia, by the way, that are covered here, have more than 30% of the population living in overcrowded accommodation. This is another way to look at this. So here you have the average number of rooms per person, and you see the same picture. So most of the countries in this region have an average number of rooms per person, which is substantially below the average of the European Union. Let me lastly turn to the quality of housing. And of course, this is always a little bit difficult to say. What exactly is a high quality housing? So the definition here is easy. It basically gives you the part of the population that lives in a dwelling with either a leaking roof, damp walls, damp floors, damp foundations, or rot in window frames. So that is something that one would normally certainly consider as a poor quality and health jeopardizing quality of accommodation. You have here a breakdown in terms of different parts of society, and you can see that single people with dependent children, they are most affected. This is basically true for most of the countries. But you also see that the total, so the average, in a number of Central Eastern, Southeastern European countries is significantly above the average in the EU. So Hungary, Latvia, Slovenia, for example, also the other Baltic countries. So here you do see deficiencies in the quality of housing that are still in place. Now, in order to change this, both the quantity and the quality problem, of course, you would need to have investment in housing, and the investment in housing is again something that is unfortunately much below the average in the European Union. In some countries like Poland and Slovenia, also Romania, Latvia, Bulgaria, you're talking about 40 to 50% of what is being spent on housing in the average of the European Union. So clearly, there is still some gap that needs to be filled. So what does that all mean, and where do I think would be priorities for the region looking forward? I would like to focus on two aspects. The first one is that I think the Central Eastern and Southeastern Europe could benefit a lot from developing a larger and a better functioning rental housing market. Now, there are different ways to do this, of course. It can be done by incentivizing private rental markets. It can be done by rebuilding publicly a social housing stock. It can be done by supporting limited profit housing associations, as it's being done in the city of Vienna, for example. It's also referred to in the report. I saw that. So that depends on the specific situation in the country. Maybe a combination of these approaches would be particularly helpful. A rental market would have many benefits. A better rental market. It would help facilitate international mobility, which would have a positive impact on growth, and also, given the demographics in the region, that is not to be underestimated. It can also, interestingly enough, help to preserve financial stability for a number of reasons. So if you have countries with a lower rate of private home ownership, you are likely to get not as severe and not as long house price and credit cycles. That's one important element. Another element is that rental markets provide what I call here marginal borrowers. So borrowers that really for them it's problematic to afford a mortgage. They get an alternative, right? So they don't need to get into a mortgage in order to have accommodation where they need to live. And lastly, a rental housing market that's sufficiently large reduces the social impact of borrower-based measures like loan-to-value ratios, loan-to-income ratios that were discussed earlier on. So probably reducing also the inactivity bias that macroprudential policymakers often have. It takes a long time to do this. This is very clear, but of course that should not be an argument not to do it. Second point, and this is related to the first, I would see a clear need to increase investments in residential real estate in this region. The region still has a problem in terms of the quantity and in parts the quality of the housing stock. But as I showed you, the investment levels are still relatively low. So there is a need to incentivize both private RRE investment. And of course, the report holds many possible reforms, describes many possible reforms and measures that can be done. There is no silver bullet, there is no uniform best practice here. So a bespoke, a country-specific approach would be needed to identify what are really the main bottlenecks and how can they be addressed. It seems to me that there is also a clear role here for public support for this type of investment. In particular, if you want to deal with the inclusion issues, which you see in the region, and if you want to address the affordability and sustainability trade-off. And this is something that is probably quite pronounced in the region, given that overall income levels are still much below the EU average. So here, a public intervention may be well warranted. The good news is that EU cohesion policy and maybe also the EU COVID recovery funding can really help to alleviate some of the fiscal bottlenecks that may exist in this part of the world. Last not least, are these suggestions, these measures to invest more, to incentivize more RRE investment and construction, is this likely to lead to another boom-bust cycle in the region, as we saw it about 15 years ago? I don't really think so. So first of all, some of these measures would be more in the public rather than the private field anyway. But even for support for the private field, I think the risk for another boom-bust cycle is substantially reduced. First of all, because there's been in the meantime a strong rise in macroprudential policy, and this is widely and generally quite actively used in the region, and that helps a lot to dampen the cycles, as we know. Second, banks tend to be better capitalized than they were in the past, and the funding patterns in these countries have become much more domestically based and sustainable. This notwithstanding, of course, careful financial risk surveillance and assessment obviously remains crucial. So in closing, I would like to congratulate the OECD again for this excellent work, and I hope the report finds a lot of attentive policy-making readers in the CESEE countries. Thank you very much indeed.
Thank you very much, Rainer, for this interesting comparative perspective with a focus on CE countries and also for the very concrete policy conclusions that you gave. I think the best way to use our scarce remaining time would be to offer Luiz the opportunity to react to at least some of the comments. Luiz.
Thank you very much, Ernest, and thanks really to John, Florian, and Rainer for these very useful comments and insights, and on behalf of all my colleagues who've been working on this, many thanks for your positive feedback. John, you mentioned, I like very much your green land value tax proposal. So I think that is a very interesting way of dealing with many of these issues. I would also like to put on the table another possibility on the financing side, which is also to facilitate the development of green mortgage markets. I think that there is a lot of potential to basically make sure that we tie together energy performance standards and as a way of reducing the cost, so improving the energy efficiency of buildings, reducing the burden of housing costs related to energy on borrowers, and that can be then reflected in lower cost of borrowing. So I think that the initiative of the European Mortgage Federation, if I can mention one of them, I think is a very, very interesting one in this respect. And we already see some evidence that the development of those market instruments can then reduce already the cost of borrowing and at the same time increase reduce the environmental footprint of housing. We need a lot for that. Need properly, obviously, more development on ESG taxonomies, much better labeling of these products, and all the things that we know that are important for the development of finance for that. But I think your proposal, John, on the tax front, better instruments on the finance side could go a long way. You mentioned the new technologies, related to carbon capture and storage. That's a very interesting area, an area where there is a lot of developments that we will probably need to document better moving forward as a way of complementing the discussion with a more explicit focus on climate, as you suggested. Florian, I couldn't agree more. The issue of trying to split developments or to decompose the developments in house prices between land and construction. And I'm glad you saw the logic of what we were trying to do, even though we didn't have a very formal decomposition the way you proposed, by looking at land use regulations, we could focus on the areas where tensions are most obvious. I mean, after all, there will be considerations that you acknowledged yourself related to choices as to how much land should be protected for other uses, including the preservation of green belts around the cities. It's a matter of social choice, and it's a matter of following the evolution in different parts of the world. But to the extent that less restrictive land use regulations can then alleviate the pressure on prices of land and then on the prices of housing, that could be a way forward. And Rainer, you put your finger on the important issues there. Given the legacies of transition and the experience of central planning in Central and Eastern Europe, we also agree that it's very important to develop rental markets. We've been working with the Latvians precisely on this issue. and making sure that more broadly in the region, I think that I would take a step back and say, you know, we're talking about a part of Europe where productivity growth has stagnated, where the catching up in living standards relative to the more prosperous countries in the region has stagnated as well. So to the extent that housing mobility, if that can be facilitated through more liquid and more dynamic rental markets, if housing mobility can become a pathway, or at least, you know, if you can remove the obstacles associated with mobility for labor mobility in general, we may find sources of productivity growth in the region that would allow for this process of catching up to resume in the course of the recovery. Also, you mentioned the potential that there is for the European recovery plans. Since we are at the beginning of a new programming period, and we see already the importance that many countries are putting on housing as part of their strategies, I think it's a very important moment where European countries can try and make progress in areas where progress has been harder to achieve over the last few years. So very interesting point that you made there. And with that, Ernest, I think I tried to pick on a few points. Of course, I wouldn't be able to do justice to all the other comments that were made, but again, thank you very much for the opportunity, for the insights, and for the exchanges today.
Thank you, Luis. This concludes our webinar on housing policies. I think we used our 90 minutes well to give a rich overview of burning issues in housing and how to address them optimally, using synergies, but also being aware of trade-offs. Let me thank Luis, John, Florian, and Rainer for sharing your insights, and all of you for your interest. Let me once again advertise this fabulous OECD report, which you find, of course, on the OECD website, but which we linked also on SUERF's website, where you will also find the PowerPoint presentations. I thank you all for your attention, for being with us. Bye-bye, take care, and have a nice summer. Cheers. Thank you.
Thank you very much. Thank you.